Are you a small business owner with a modified adjusted gross income of over $500,000 a year? If so, then you need to listen up if you want to potentially take advantage of some of the increased tax breaks available under the One Big Beautiful Bill. Now, the One Big Beautiful Bill just raised the state and local tax deduction, also known as the SALT cap, from $10,000 to $40,000. That means that up to $40,000 of taxes that you pay to the state or municipality where you live can be deducted against your federally taxable income, which is a great win for taxpayers. But it is not a permanent addition to the tax code, and an even bigger but, it isn't available to everyone. What do you mean by that, you ask? Well, don't worry, stay with me, and I'm going to walk you through it. Here's the deal. The increase in the SALT cap is only assured to be in place through the 2029 tax year. In 2030, it's scheduled to revert back to only $10,000. So you want to take advantage of it while it's available, but there's a caveat in the tax code. You only fully benefit from the increase to $40,000 if your modified adjusted gross income is $500,000 or less. For every dollar of income where your modified adjusted gross income exceeds $500,000, the deduction gets reduced by 30%. So by the time your modified adjusted gross income reaches $600,000, that equates to a $30,000 reduction on the $40,000 SALT cap, and you're back down to $10,000 in state and local tax deduction, which is the floor. It's as if there was never any legislation that lifted the SALT cap for you in the first place. Now, the majority of the population will benefit from the higher SALT cap. But there will also be tens of thousands of business owners out there that will miss out on taking advantage of this tax benefit because they didn't plan adequately. Now, we want to help make sure that you don't become one of those statistics. Well, my modified adjusted gross income is $750,000, you might say. I don't want to miss out on the increase in the SALT cap over the next 5 years. Is there anything that I can do? Yes, there is. Stay with me. So if this scenario describes you, you need to shelter $250,000 or more from your current income to move your modified adjusted gross income down to $500,000 or lower, which would let you take advantage of that increase in the SALT cap. Did you know, as a small business owner, that you may have the ability to shelter the income that you need from your current 1040 using a combination of retirement plans? These are not some fly-by-night tax shelter schemes. These are retirement planning strategies that have been used by sophisticated investors for years, all recognized by the IRS. If you need to shelter $250,000 a year or more, your 401k alone isn't going to cut it. If you're over 50 years old in 2025, you can contribute a maximum of $31,000 to your 401k in salary deferrals. That's the standard contribution of $23,500 plus $7,500 in catch-up contributions. And there's even more catch-up contribution available if you're between the ages of 60 and 63, but we're going to ignore that for now. Also, starting in 2026, per the new Secure 2.0, all of these catch-up contributions must be made with after-tax money, which is not going to help you towards sheltering the income you need to get back underneath this $500,000 level. So you were at $750,000 in total income, but after putting $31,000 in your 401k, you're now down to $719,000. Still well above $500,000, right? But as a business owner, you can also make company contributions, right? This could be a matching contribution or a profit-sharing contribution, which would require the bolt-on of another plan. But these company contributions can now add a maximum of another $46,500, bringing the total amount to $77,500, including your salary deferral. That $77,500 is the Section 415 limit of the Internal Revenue Code for defined contribution plans in 2025. But okay, so that brings my taxable income, so we were at $719, brings us down by another $46,500, which gets me to $672,500. So we're making progress, but we still have a ways to go. Enter the true hero that we need, which is the cash balance plan. A cash balance plan is another IRS recognized retirement plan. But unlike the 401k and the profit sharing plan, which are considered defined contribution plans, the cash balance plan is a defined benefit plan. Defined benefit plans can supplement or stack on top of other defined contribution plans. But here's the kicker. Cash balance plans can allow for hundreds of thousands of dollars of tax-sheltered contributions each year. The contribution level is determined by an actuary, but in our hypothetical example of a business owner over the age of 50 with $750,000 in modified adjusted gross income before retirement contributions, that annual contribution can easily be $162,500 or more, which is, ta-da, magically the amount of additional tax shelter that you need in order to get your adjusted gross income back below the $500,000 threshold necessary for you to take advantage of this higher SALT cap. So in doing this type of planning, you can unlock not only some significant tax savings, but you also unlock the ability to leverage this new improved SALT deduction for at least the next 5 years. So I'll end with this question. Did I describe your situation? If so, I want to let you know that you may still be able to take advantage of the increase in the SALT cap, but it requires some advanced planning by competent professionals that understand retirement plan design in consultation with your tax advisor. These plans are nuanced, but may very well be worth considering. We at Reveille are always happy to engage you in that discussion. So send us an email with questions or to schedule a consultation, info@reveillewealth.com. May your incomes remain high and your tax liabilities be as low as possible. Take care, everybody. We'll see you next time.